Start by looking at this Bitcoin chart. You see these buy signals, every single one of them losses. Not because the market is random, not because risk management failed, but because these signals are against the trend. This is the mistake most traders make. They follow signals without filtering direction. In this video, I'm going to show you how to remove these losing trades before you even enter them using 2 free indicators and 1 simple setting change. And by the end, you'll see the exact same chart cleaned up with only high probability trades left. Now let's reset and build this correctly. We always start the same way. We identify the trend, we trade only in direction of the trend, and we filter out low potential signals, and we apply risk management on every single trade. Whether you're trading or investing, the market always carries risk. There's no exceptions. This approach is built on simple rules, 3 indicators, and a strict risk management plan. The first indicator we use is trend levels by chart prime. This indicator identifies the structure of the trend by plotting a high level, a mid level, and a low level. These levels are calculated in real time using the highest price, the lowest price, and the midpoint over a customizable length. It also measures trend strength by tracking how many candles close above or below the midline, which tells us whether the trend is holding or weakening. To add it to TradingView, go to Indicators, search Trend Levels, and apply it to the chart. When the trend changes direction, the indicator prints arrows. These arrows are meant to signal potential reversals. But here's the crucial issue. On its own, this indicator can generate counter-trend signals. Look again at the Bitcoin chart. The trend is clearly down, yet buy signals keep appearing. If you take those trades, you lose capital. Not because the indicator is broken, but because those signals are low potential and against the dominant trend. So the first objective is to identify those bad trades. And the second objective is to escape them completely. Before adding anything else, we make one simple adjustment. Open the trend level settings and change the length to 27. That's it. This reduces noise and improves structure, but it still doesn't solve the problem entirely. That's why we add a second indicator. The second indicator is called Trend Indicator A-V2. This is an open-source TradingView script designed to show the overall market direction using moving averages and smoothed Fibonacci calculations. To add it, go back to the indicator section again, and this time search for Trend Indicator A-V2 and apply it to your chart. By default, the settings are too sensitive, which creates confusion. So we adjust them. Change the moving average type to simple. Set the period to 300. Set the Almo shift to 1. Set the Almo deviation to 15. Then set the ribbon colors to green, red, and white. At this point, the chart becomes clean, simple, and easy to read. Now, the rules are very clear. When the ribbon is green, the market is bullish and the trend is up. If the price is above the green ribbon, we only look for buy signals, and sell signals are ignored. So now, when the ribbon is red, the market is bearish and the trend is down. If price is below the red ribbon, we only look for sell signals. Any buy signals is ignored. And if the price is not clearly aligned with the ribbon, we do nothing. Now look back at the Bitcoin chart. The ribbon is green. Price is above it. So the trend is up. Even though the trend level indicator prints sell signals here and here, we skip all of them. Those trades never exist for us. This alone cuts losses before we even enter the market. We wait. And when a buy signal appears in the direction of the trend, that becomes our entry. For a buy trade in an uptrend, the stop loss is placed slightly below the most recent swing low or near the lower border of the trend indicator. The target is set to 1.5 times the risk. This does not change. In a downtrend, the logic is exactly the same, just reversed. When the ribbon is red and price is below it, we ignore all buy signals and only take sell signals. The stop loss goes slightly above the recent swing high and the target remains 1.5 hours. This strategy works because it respects the most important rule in trading: the market always carries risk. By trading with the trend, filtering low potential signals, and applying a strict risk management every time, execution becomes systematic instead of emotional. Simple rules, free indicators, no guessing. Master this process first. Only after that should you consider adding anything else. Happy trading!